Front and center this hour, the state of the tech union with Nvidia, Salesforce, Snowflake, all reporting earnings tonight. We discuss and debate what is on the line for these markets with the investment committee. Joining me for the hour, Joe Terranova, Shannon Saccocia, Jim Leventhal, Rich Saperstein. Let's go to the markets, give you a look at the picture. 12 noon, NASDAQ is leading as we look ahead to these big events. It is, I think, fair to say, Joe, the biggest day for the tech trade in some time, not just because of Nvidia, but given what's happened with software, with Salesforce and Snowflake also reporting. The NASDAQ's the only major average to be down year to date. Most of the mega caps are as well. Take it from there.
Well, I think the market was able to shrug off the earnings report from Workday. So I think really the bellwether, and I'm going to call Nvidia the bellwether because I am 100% confident that exactly is what it means to the marketplace. That bellwether is critical, and it's critical because the mercurial nature of 2026, we see it represented today. The leading four sectors for the S&P all up greater than 13%. They're all down today. The worst performing sector, financials, that's higher. Software is higher. Crypto is higher. Technology coming back once again. So I think what's critical about Nvidia this evening,
and the software ones. I think that
I disagree.
No, not given what's happened with the software.
We have
trade
stabilization today. Workday.
One day means nothing.
Workday. Workday was down. We were expecting that would bleed into the software names. Continue. I think you have stability in the software names, and I go back to the live stream yesterday from Anthropic. I think that was critical in giving a little bit of comfort to the market, in particular the software industry.
How can you have stability? One day means zero. IBM's down another. IBM on the week is down 7%. Who cares what it's doing today? Snowflake is down on the week. Who cares what it's doing today? CrowdStrike and Palo Alto and some of these other names are down on the week. Who cares what they're doing today? Which is why, Rich Saperstein, I would submit to the court as the judge.
I disagree.
That the tech trade in general has so much riding on it today. Salesforce and Snowflake are arguably two bellwethers in terms of the questions about AI and what's been happening there. So yeah, all three add to the importance today.
Look, the offensive team is off the field right now, and the defensive team is on the field. And that's probably going to carry on for, I don't know, weeks, months, who knows. But I think there's a defining point where we have to look at what price you're paying for earnings and the growth in earnings, which is PE to growth. And if you look at the staples, whether it's Procter & Gamble, Clorox, Coke, Kimberly-Clark right now, the PEG ratios are anywhere from 2.5 to 5. I own Procter. It's 5 times right now. If you focus back on the Mag 7, the bigger stocks, the PEG ratios are 1 for Google, 1 for Meta, 1 for Amazon, and 1.5 for Microsoft. So at some point, the market will redefine who's going to be on the field. Right now, it is clearly the consumer staples. As it turns to Nvidia, they're going to put up good numbers because the hyperscalers are basically is spending $670 billion this year.
Doesn't mean that the stock is going to trade in kind, right? The stock has been stalled. It's run a little bit into the print. So a great report doesn't necessarily mean great price action. And that, frankly, is something probably more interesting to watch than anything else. I would also suggest, as Piper Sandler today downgrades tech to neutral, B of A's credit investor survey says AI bubble now seen as the #1 risk for the first time ever. Okay? 23% investor risk for the first time ever, AI bubble. So, Shan, that says to me why I framed it from the top the way I did. Joe's sort of sitting back looking at me like I'm crazy because I know he wants in
Never
again.
Crazy.
He's leaning like
so many
this,
things to say.
looking at me. And I know when he does that what it means, and we'll get you in a minute. But Shannon's sitting next to you, and I want to get to her first. Sure. That's why I framed it the way I did.
And I think your point, Scott, is that the market right now is teetering between oversupply versus obsolescence. And I think that regardless of that B of A survey, I think investors are looking at what is the broader impact of AI. AI. A couple months ago, we were all talking about the potential productivity enhancements, the creative destruction and disruption of businesses and the opportunities for growth. Now we're looking at it from the perspective of maybe some of these business lines are no longer relevant in terms of this AI. But I would point you back to Nvidia. You made a great point. And Rich, you sort of talked about this already. Valuations, if you look at consensus expectations for EPS for Nvidia for 27, 1017, implies a multiple of about 19 times, Scott. So given your point and how much demand has already been stated, put on paper by the hyperscalers, Nvidia, I have to agree with Joe here, continues to be really important in terms of corroborating those expectations.
Hey, I didn't say it wasn't the bellwether. I'm not the one who said that. D.A. Davidson was the one who said that yesterday.
But I will agree with you that we get a blowout in earnings on Nvidia. I actually don't know that completely tamps down some of these concerns on software. And I think, again, the obsolescence idea, this disintermediation, this is going to be a rolling concern between now and when we start to get earnings again for second quarter.
I'm saying, Jim, that when Piper Sandler downgrades tech, and then Bank of America's credit investor survey says the AI bubble is now the #1 risk for the first time ever, that's why I think there's added and greater importance on these in total today. The two software names along with Nvidia.
Well, look, I am today focused on the software names. Part of that is because Nvidia, we all agree, should have an excellent quarter, an excellent guide, and the stock's running up into it, so it gives me some comfort that it will probably respond well.
I don't know. You know what?
I know.
They've seen muted earnings.
But the reason
that the stock has not moved a whole lot in recent prints. That's another thing.
True. That's absolutely true.
The stock's gained or fall in less than 3.5% after the last 3 reports.
That's absolutely true. But the fact that it's rallying the last few days into the report gives me some comfort. Maybe I'm wrong, but it gives me comfort. Where I am still concerned is software. Now, I do have to say with this D.A. Davidson report that when we say AI bubble is the biggest concern, are we saying that the data centers...
That was the Bank of America credit investor survey.
There's two things that can't be true at the same time. We can't have this massive overbuild of data centers and then at the same time say that AI is killing everything in its path. I just don't see that as a viable duopoly.
No, again, it's their credit investors, so it all plays in the same story. Well, if you're borrowing hand over fist to build data centers and to raise capital to deploy towards the AI trade, well, if you're overdoing it on all accounts, like the market has placed its bets at certain times with some of the names out there, whether it's the private credit names or the Oracles of the world or others, that's why you get #1 risk for the first time ever, according to them, an AI bubble.
Just go back to where I just want to finish my point really quickly, because software is, to me, the more important part today. And I think the Workday earnings report basically doesn't answer the question. Because on the one hand, hey, they've got 12 to 13% growth going forward. On the other hand, that's down meaningfully from the high teens of a year ago. The one thing I will point out on this, and I think it applies to Salesforce, applies to Adobe, applies to all of these guys, is that their share price charts actually exactly mimic their valuation charts. It's not a question of earnings. It's a question of what we're paying for earnings. And I think when we're down at roughly 12 times for some of these companies, that it's cheap enough. And that's why Workday is actually slightly positive.
It's what you're paying today for your idea of what the future earnings are going to be.
A lot of
You're
questions
not paying
about that.
these prices based on what you think today's earnings are going to be. The real fear is that you might have to pay even less because you're more worried about what future earnings are going to be. You got to keep that into perspective too.
That is in my perspective, and what I'm saying is specifically, if you look at Workday, just as an example, I don't own it, but 2 years ago, stock traded at roughly 35 times. Now it's trading at 12 times forward.
For a reason, isn't it?
Yes, and the question is, what you just said, Scott, about the skepticism about what forward earnings are actually going to be, is, I think at this point, appropriately priced at 12 times. At 12 times for an asset light. These are asset light.
You're
companies.
trying to be a rock star. They keep telling you at Workday not to be a rock star. You watch these commercials.
You think I'm trying to be a rock star?
You watch these commercials.
I'm just telling you what's on my mind. I'm just telling you what's on my mind.
Billy Idol is telling you don't be a rock star.
Billy Idol? Okay.
He's in the commercials.
Okay. All right, now I know what we're talking about. Sorry, I kind of...
Jimmy.
Look, man.
Jimmy, have some water.
I'm not an HR guy. So those are good commercials, but they go right, in one ear and out the other. I'm sorry.
Just save him.
I know Joe wants to get in on this, but I think I want to note something that you just said, Scott. That was from the credit analysts, right, at Davidson. There's a reason that there's equity investors and credit investors.
Yeah, the equity investors ain't feeling much better.
But AI actually creates hard-to-price price tail risks for bondholders. And I think that you're going to continue to see some dispersion in terms of views on credit versus views on equities. And I think that investors need to take that with a grain of salt in terms of thinking about what is the earnings going to support. That may not be as supportive to bondholders because of that cannibalization for CapEx.